Okay, this is another one in my series of trading for beginners who have never traded before. And with this, I'm recommending that you trade Forex. It's a good place to start. You don't need a lot of money to get involved, and you can trade small amounts, and you can trade standard lots, you can trade mini lots, or you can trade micro lots. So you can be in the market and not be very expensive. You don't make as much money, but you also don't lose as much money too, which is the name of the game, is not losing money and it's making money. So where we left off is in the rules is the trend is your friend is the next rule. And if the price is moving up or down, it is better to trade in the same direction. There are signals showing a change in direction. Counter trades going against the trend are dangerous. Apparently, people that study these things, I think it's 72% of the time, if you go against the trend, you lose money. If you go with the trend, you make money. So 72% loss rate, that's not good. And that's basically, if you jump into the river and you swim with the current, you're going to go along and cover a lot of distance. Where if you try to swim against the current, you're going to go very slowly and you're going to get very tired and so on like that. So it's basically the same thing when you're trading stocks or commodities, Forex, whatever it is. If you try to go against the trend, the odds are against you and you're going to lose money. There are setups and times that you can do what's called counter trend trading, and those are very specific, but a lot of traders, experienced traders, rarely use that. But a lot of the new traders, and myself included, they're like, oh yeah, it's going to change, it's going to go in the other direction, it's gone so far in this direction, it's going to turn around and it's going to go up. So you turn around and you buy the stock and it goes down more and you end up losing money, or vice versa. You're sitting there and it's going up and you're going to go, it's going to reverse any minute now, so I'm going to sell it and get out. And of course you sell it because you figure it's going to go back down again, and it doesn't. It goes back up. So the trend is your friend, and for the beginning trader, stick with that. Always trade in the direction. You're not guaranteed that you'll make money, but definitely at a 72% average of losing when you do what's called counter trend trading or going against the trend, you're far better off taking your chances of going with the trend. Okay, the next one, and this is very important. A lot of traders don't do this, and a lot of traders lose a lot of money. Always trade with a stop loss. It doesn't matter what the stop loss is, how big the stop loss is, where the stop loss is, it doesn't matter. Always put a stop loss in. When I first traded, though I knew what a stop loss was, I didn't trade it. And as I explained earlier, I had a stock that I had bought at $75 a share, so I had $7,500 invested in that stock. In the morning I went into work, came home in the afternoon, and it had gone down $5,000 and it was only worth $25 a share. So I didn't have a stop loss, so I lost $5,000. If I had a stop loss, then with stocks, most people recommend you do 10% stop loss on any trade. So since it was $75, 10% would be $7.50. So when the price dropped to $7.50, I would have been out and I would have still had a loss of $750. But $750 is a lot better than a $5,000 loss. So there was more trades like that. I had trades, the stocks that I bought around $25, and I watched them go to literally, $1. And, I just, oh, it's going to turn around and so on like that. But if you got a stop loss, If there's a sudden move in the market, bang, you're out, you're safe. As I discussed with about the individuals that were buying GameStop on the other video at over $300 a share, if they had a stop loss in, yes, they would have lost money, but they wouldn't have lost much. So at $300 a share, basically they would have lost $30 because, you know, the 10% rule. There's different things that you do. One of the rules in investing is you use the last high or the low. So if you're buying the last low point, you put your stop there, because if it goes below that low when it's trading, obviously it's going down, so you better get out. And same with, you know, if you've sold something, sold it short, or you're in currency pair, which, you know, you're just trading one way or the other on currency pairs. If you sold it, it comes back and hits the high point, then you're out with a minor loss. Another thing that is often used is what's called a trailing stop, and that's where you set it up. So let's use my $75 stock for example. You put it in and the stop loss is $7.50. Well, a trailing stop is as the price goes up, the stop follows it up. But as the price comes back down again, the stop doesn't go down, it stays up. So the stop only goes up. So what happens is it goes up and the stop trails. Well, of course, if it goes up $7.50, your stop is at now break even, and it's what's called a free trade, because if it goes down and takes you out, you don't lose any money. You can only gain money when that happens. So that's a trailing stop, and that's a method that is used and very common in investing, is a trailing stop. So you can walk away, you can go downtown, you can go swimming, you can go to the park, you can go shopping, you can go to work, and your trailing stop will, as the price goes up, it'll keep locking in your profits or reducing your loss as the price goes up. And if it does come down, your losses are less as the day goes on. So always trade with a stop loss. Now this brings us to another rule, and this is very common. I've done it myself, and you can just keep doing it until you lose all your money. And that is, it follows along with the stop loss. Never open up your stop loss. And what that means is, again, my $75 trade, I have $7.50. Well, you're watching the price come down. It comes down to, you know, $6. It comes down $7, and you're thinking, oh gee, it's just about to hit my stop loss. I've been stopped out before and it's turned around, so I'm going to move it down to, instead of $7.50 down, I'm going to move it down to $8 down, you know, in hopes that it reverses and I don't get stopped out. It comes down more, and you open it up to, you know, $9 stop loss. It keeps coming down, and basically it keeps coming down until the point where you turn around and you say to yourself, oh, that's it, and you get out, and it's, instead of being $7.50 loss, you've got a $20 or $30 loss. So major rule in investing, never open up your stop loss. Whatever you do with your stop loss, you either tighten up your stop loss or you leave it where it is, but you never open it up. Another rule, and this is sort of counts back to the fear and greed, is it's better to be out of a trade wishing you were in than in a trade wishing you were out. If you're not in a trade, you're not losing money. You're not making money, you're not getting any profit, but you're not losing any money, and that's the name of the game, is you don't want to lose money. Now, if you're looking at this and the stock is going up and you're not in it, you're like, oh gee, I should have bought it. That's definitely a better feeling than you buying the stock and it going against you. And lo and behold, then your fear comes in, you're upset, you're sweating, your heart rate is racing, and so on like that. So you don't have to be in the trade. So this is it. If you're not sure about the trade, it's better not to go in the trade. It's better to be wishing you were in a trade when you're out than it is to being in a trade and wishing you were out. So that is an important thing, and that has a lot to do with the trading. The next one is fear the zero and dread the double zero. When price reaches a zero, so let's say $10, $30, $120, when any trade hits that price, it has a tendency of going and reversing. That's whether it's coming down or going up. And I've heard it called a banker's trade. And so basically what happens is a lot of the bankers, and investment firms and so on like that, they sit there and they say, well, if the price of the stock hits $30, we're selling it. Or if it comes down to $30, we're going to buy it. Or if it hits $120, we'll sell it. Or if it comes down to $120, we'll buy it. So if you're looking at getting into a trade, and let's say it's $9.50, well, there's a good chance when it hits $10, it's going to go down, and it's going to go down more than what you were hoping. Same with $30. If it goes to $30, chances are it's going to reverse, and you're going to lose it. So if you're looking at, oh, I should sell it, don't sell it at 30, because what happens is a lot of times it'll hit 30 and it'll turn around and go back up again. Or if you're thinking of buying it and you buy it near 30, there's a good chance that it's going to stop and reverse on you. So that's the fearing the zero. Now, the dreaded double zero. Okay, this is 100 or 300 or 1200. When there's the double zero, stocks do not go through those numbers very easily. They will stop and go back down. They'll come up and go back down. And because the same as the zero, people are like, oh, it's going to go to $100 and it's going to, I'm going to make a fortune. A friend of mine years ago invested in silver. He had a lot of silver. Price of silver went up. At $95, his broker called him up. You got to sell. And he's going, no, it's going to go to 100. It's going to go to... The broker's going, it'll never hit 100. You got to sell. And he knew better, and he says, yeah, he's going to... Sure enough, just around the $99 or $98 mark, the sellers came in and started selling their silver because, hey, it's, hey, it hit its target, so we're going to get out with our money. And that price of it dropped right down, and because of the selling pressure, it started hitting stop losses, which further pushed it down. People started to see that silver was tanking, so they were selling their investments and everything. So he went from literally being a millionaire and not listening to his broker to basically where he started before the run, and he didn't have his, I can't remember what price it was, but he came back to his price. So he didn't make any money. So the double zero, as hard as it is to get out of the single zero or past the single zero, the double zero is massive amount of support and resistance. So you got to watch those things. And you see a stock going up and you're thinking, hey, I got to buy into this thing, it looks good, everything is great, and it's coming up to the $100, and you buy into it, and bang, it turns around and reverses, and you lose your money. So that's those you have to worry about. Okay, that's good enough for this one, and I will go on to the next one, and we've got some more rules for that and explanations and so on like that. So if this has been of any value to you, I'd appreciate if you'd hit the like and subscribe to my channel. I have different things that I put up on my channel, and this is just one of them. I've had many people ask me about investing, so this is why I'm doing it. So join me for the next one for more of my trading rules. Thank you.